We're going to take a look at the compound interest calculator here to show you how you can become a millionaire with a simple index fund strategy. But if you're already familiar with this, feel free to use the table of contents down below to skip ahead to the section on specific fidelity index funds. But what we're looking at here is a compound interest calculator on the investor.gov website. And we're just going to do a couple of quick examples here showing you how a passive index fund investing strategy is the best approach out there for becoming a millionaire in the long run, leveraging the stock market. And of course, I don't expect you to just take my word here. Instead, let's take a look at what Warren Buffett has to say, arguably one of the greatest stock pickers of our time. Well, even Warren Buffett himself has said that investing in a low-fee S&P 500 index fund is the best approach out there for most investors. And he even went so far as to have a bet against 5 hedge funds, where he said that over a 10-year period, the S&P 500 alone, which we're going to explain what that is shortly, would outperform their actively managed portfolios. And take a look at this right here. The 5 funds had an average performance in that time period of 36.3% after fees, which are much higher with active management, and the S&P 500 returned 125.8%. And just to give you a visual example here, we're looking at the FinViz heat map of the S&P 500, because a lot of people think the S&P 500 is this boring investment for like your grandfather, but it's really not. And what a lot of people don't realize is this is a market value weighted index. What that means is the larger a company is in terms of their market value or market capitalization, the more weight they're going to carry in that index. So when you are investing in the S&P 500 these days, a lot of your money is going into Microsoft as well as Apple, Google, Meta, Nvidia, Amazon, and smaller amounts of your money are going into things like industrials and companies maybe that may have done better in generations prior. So now let's jump back over to that compound interest calculator, and I'll just show you how you can become a millionaire with a simple strategy. And according to Investopedia, the average annualized return since adopting 500 stocks into the index in 1957 through the end of December 2023 comes in at 10.26%. So we're going to go ahead and use that figure for our calculation. Let's say you had an initial investment of $0 because you're just starting from scratch, but you want to invest $100 per month into the S&P 500, and let's say that you went ahead and did that for 10 years of your life. What would that look like? Well, if we click on the calculate button, we can see here that would grow to $19,300 and some change. Nothing too crazy, but it is, a decent amount of money to have set aside from just $100 per month. And if we look at the difference here between these lines, it shows us the contribution here was $12,000 and the total value is $19,000. So it's about $7,000 in gains from the market. Now, if we go ahead and change this to 25 years, you're going to see the magic of compound interest taking effect, and now you have a 6-figure portfolio. Let's go ahead and push out another 10 years to the 35-year mark now. And at this point, you would have $345,000 in that portfolio. So maybe you started at 20 and now you'd be 55 years old. But I want to add 10 more years now and go to the 45-year mark. And that would be the equivalent of starting as a 20-year-old. And then at 65, maybe you want to retire and start drawing from your investment portfolio. At that point, you're at $936,380. So you're just shy of $1 million. If we add another year or two, maybe going to like 47, for example, at that point, you'd be at $1.14 million. So what I love about compound interest is the longer you leave your money sitting there, earning that average return, the greater dollar value your portfolio grows because you have more money earning that return. And this exponential curve here is a perfect example of that. So over those 47 years, even though you only contributed $56,400, the portfolio has grown to a value of $1.14 million just from the average return of the S&P 500 over 47 years. Now, of course, that's a pretty long time, but if you wanted to do it quicker, all you'd have to do is increase your monthly contributions. Let's say instead you were ambitious and you had $500 per month to throw into index funds, and then let's say you did this over a 25-year period, well, that would end up being a value here of $613,000 in just 25 years. And if we push that out to the 30-year mark, just like that, there's $1 million in 30 years. So maybe you started at 20, you invest aggressively, and you want to retire at 50. Well, that's how you do it. You do it with index funds. You don't do it with messing around with stock picking or anything like that.